All right, let's get into it. Fakeouts and liquidity. All right, why I don't avoid fakeouts. I manage them. One of the biggest fears traders have when learning breakout trading is the fake out. When price looks like it's breaking out, but then it quickly reverses back into the range. Most beginners believe fake out should be completely avoided. The truth is, fake outs can be avoided in the strategy that we use anyway, at least, right? They're part of the market's design. The goal is not to escape them, is to manage them profitably and reduce their impact. Okay, so obviously you know what that means. Is there in writing. I'm not trying to avoid a fake out. I'm trying to manage it. So that's why I have like no fear when you see me enter a trade strictly from volume, just in, is because I truly believe that like if I mess up the first one in good market conditions, mind. If I mess up the first one, okay, I'll just wait for the second one. And we'll get into that in a minute on how we can take the second one, whether we can wait for it to come back to the same breakout or if we wait for take the opposite breakout, right? We'll get into that. So is no avoiding fake outs in the strategy we trade, right? So why fake outs happen? Stop hunts, aka liquidity grabs. Big players, banks, institutions know where the retail traders, us, place our stop losses. They push price just past the support or resistance, trigger the stops, so they just trigger our stop losses, then they go on their way. That's why I don't know if, all of you have probably experienced this once or twice in life. Once or twice in life, what am I on about? 100, 200 times in life where price comes and wicks you out and then boop, goes exactly where you thought it was going to go. Loads of times. Press 1 as that happened to you. That's happened to you. I know that's happened to you. If took you out the game and then it's gone exactly where you thought it was going to go. All right? Yeah. Simple. So I already knew that anyway. Traders jumping in too early. That's another one. So us breakout traders, we can't wait for confirmations. So sometimes we just boop, get in. And this is what I teach mine. So even though this is why fake outs happen, um, even though I teach us to trade fake outs, because I always tell us, don't try and avoid a fake out, get in, manage it, because when we do actually catch the move and it's not a fake out, we can win big. If we trail that stop loss or if we let it run, whatever. I think the more that you trade this strategy, the more you get used to it, the more brave you get with it, or you don't. And then also fake outs happen because of market noise. So smaller time frames like the 1 minute and the 5 minute, we get faked out a lot on. So it's sorry, genuinely just had food and a coffee. This isn't good. So right, genuinely, us lot, we trade these lower time frames. If you go to the 4 hour time frame, you're not likely to be faked out. Like it take you 4 hours to be faked out unless it was a really, really high impact day. All right, you're not gonna get faked out on the 4 hour, the daily, and stuff like that. I mean, you could be wrong, but you're not gonna get wicked out much and faked out a lot because it takes a whole day or 4 hours to do that. We get wicked out and faked out a lot on the 1 minute time frame because it's the 1 minute time frame. It's crazy. It's absolutely mental. So you know, yeah, volatility can make it look like a breakout when really it's just a random movement, and that's the truth. A range on the 1 minute time frame is absolutely mental, and it's just nuts. But that's what we trade. We're scalpers. So why I don't try to avoid them. If if you only trade perfect breakouts, you'll miss most of the best moves because almost every breakout starts messy. All right, so think about that. When people are trying to look for the perfect breakout, they want to break, they want to retest, they want an engulfing candle, they want a close. All of these things, they actually make you avoid getting into the trade in the first place. When you see me on most of my videos just hitting buy or hitting sell, it might look reckless to you lot, but I know that I'm gonna handle that drawdown, or if not, I'm gonna close. I'm not gonna let my account go into too much red. So that's me actually managing my risk, and like that's my actual strategy. That's my plan. So avoiding fake outs makes you hesitant, second guess yourself, and late to entries. That's why I always say I'd rather push the button early and manage the trade early instead of getting in when it's already broken a level, 20 pips up. That 20 pips was like all I was targeting anyway in the first place. So you know what I'm trying to say? Instead of running from them, I use them as a filter for strong setups and opportunity. Yeah, okay, that's also true. So what I mean is, um, if I do decide like to get in and it goes against me, and I can see either a big rejection and I can see to the left and go, okay, this is where it ties in with the liquidity side, which is coming up in this lesson. But, you know, fake out, liquidity, all right, it was a grab. Next candle comes down, yeah, I'm getting in. So I can also use fake outs as a filter. So it's kind of like you got to fuck up the first position just to get the second one right sometimes. Put 1 if you understand, 2 if I'm going too fast, because I feel like the coffee's fully kicked in now. Yeah. But no, I think this is making sense. Yes, I'm awake. Right, cool. How I manage fake outs instead of avoiding them. So every breakout trade I take has a tight stop loss, right, relative to my target. So what that means is, oh wait, sorry, and if it's a fake out, I'm out quick and it's controlled, right? I don't fucking blow my account. So what that means is with Nasdaq, for example, I use a 20 pip, 25 pip stop loss. I'm going for like a 1-to-1 at least minimum. But then when I'm at a 1-to-1, because I go in with like 2 positions usually, I'll close one, so I've secured the 1-to-1, then I'll let the rest run. Okay, so you see that a lot on my YouTube videos, or I just take the money when I'm happy. But the point is, realistically, you want makes sense. Yeah, I go nice and bro. No, but realistically, you want a small stop loss, because a tight stop loss. Sorry, when you break out trading, because you want to be, like I said, if we're entering and we're not even thinking if it's a fake out or a real move, we don't want it to be massive kind of thing. Do you know what I'm saying? We want to be in profit pretty fast. So that's why you need to really figure this stuff out before you even press buy or sell. That's why I really don't use a stop loss or a take profit anymore. I'm just in and I'm out. I'm controlling that shit. So I feel more in control. B, multiple attempts are allowed. So that's why I take 2 trades, all right? I accept that the first breakout attempt might fail. I'm ready to re-enter if price reclaims the breakout zone and gives confirmation. Now, every single one of these points, I think the next slides are all going to be pictures, and my bad, they're going to be pictures and they're going to be examples on every single one of these things. So, C, break even and partial profits. This is what I was just saying about when we hit 1-to-1s, we secure like half the position or we move to break even. So if it flips into a fake out, I don't give back gains. Exactly. So I'm not giving back all of my money. So say like I'm up 500. No, I'm up 500. But I've entered twice. So I'm up 1,000, sorry. I'm going to lock off 500 as soon as it's 1-to-1. Boof, close it. Then move my stop loss into break even. Let the rest run. Or just close it. So it's totally up to you. And then D, psychology and mindset. I remind myself fake outs are just business expenses. Take that bit in. Fake outs are just business expenses. So that's actually me saying I'm willing to pay to get it wrong just to understand where it's going. So if I gotta like literally blow my first move just to get a second one right, then I will. And that's the cost of the entry, right? To catch the real explosive move. So I think we can move on. Type 1 if we can move on, or 2 if you need me to go over any of that again. I want to get onto the actual charts and show you. Nice, nice, nice. I'm seeing ones. I know I can be a little bit quick, but sometimes I can also be a little bit slow. So it's like I'm 50-50. You either get me really quick or really slow. Right now I think I'm perfect pace. So let's get on to the next stuff. Example, managing a fake out. Let's say NAS 100 breaks above resistance at 18,500. Price pushes up 30-40 pips, stops, then dumps back down, all right? This is where your stop loss gets clipped. It's a small loss, all right? With me, if it went up 30-40 points or pips or whatever, I'm more than likely not even going to let it come back into the red. So I'm just going to close back at entry and then re-enter. But basically what I was saying to you is use a small stop loss, because if price does go up and then come back down and it was a fake out, you're only losing a small amount, right? Because when you do catch the right way, you're going to be trying to go up, like it says, 200 plus points. Don't know why I've put points. I should have used pips, but whatever. So the fake out wasn't a failure. It was part of the process to catch the real breakout. So this is some examples, right? Now, if we get a push up like this and then a retracement, I'm putting my breakout line there. I'm not putting it on the wicks. I always explain I'm putting it on the body. And now as soon as that gets broken, I'm entering. So as soon as price came and pushed back up with this amount of volume, and I see the break, at one point, this big purple candle was actually blue. So I would have been entering. I definitely would have entered that trade, right? But it fakes me out. How do I know it's a fake out? Look at this. Look at the volume back down. Like instantly, I would have lost the trade or I would have had to close, right? Instant pullback candle, yeah. Okay. Now, this is the interesting bit, right? So let's go back. So let's say we got faked out, we lost the trade, or we closed the break even, right? What can we do? We can either put another breakout line there, but I'll get into that a little bit now after this first few slides. But say you just wanted to stick to the original plan and say, okay, yeah, whatever, it got me, it took me out. I'm keeping my breakout line there because now it's taken me out and swept liquidity potentially. When it does make the move back up, it's going to be a big move, right? So you wait for price to push back up to the original breakout level. Or, I wish I could draw now, but right there where this arrow is, sorry, right there, it could have been another entry there. So you could have got back in there. Let's just say you kept it at the original place. Oh, my bad. Look what happens. So it came up. It faked out. This wasn't a liquidity sweep because it didn't get higher than this wick there. All right, whatever. It was kind of more of just a fake out before the actual big move. I'll show you the difference between liquidity sweeps anyway. But the second break with volume was the actual breakout move, and then it started a bullish trend. This shit happens a lot, and this was NASDAQ stock market open, all right? So option 2 is that the 5-minute chart. I believe so, yeah. Yeah, I believe this was the 5-minute chart. I think one of the slides reveal that, but yeah, I think this is the 5-minute chart. No, I'm not sure. Yeah. It's the 5-minute chart, man. 15, 20. Yeah, so it was the 5-minute chart. But this is why I'll explain something now. I wouldn't have waited for it to come all the way back to entry and break, the original breakout line. I've seen multiple opportunities here, but we'll get into them now. This is the option I'm talking about, option 2. Look for your second entry in the opposite direction and enter the next breakout level instead of waiting for price to revisit the actual, original place. So here's the original place. We've been through it. You could wait and it could come all the way back up. Or you could have looked for the next breakout to the downside. So you get your fake out, you put your breakout line to the downside. This is why you always see me put a breakout line above and a breakout line below. So for me, using a 20 pip stop, that was a 1 to 5. And the fake out was worth it. So type 1 if you're with me, 2 if this is confusing. But the fake out was fine. Absolutely cool with losing 20 pips or even break even just to get that second entry, you know what I mean? And that's the like option that I would have used. But we seen what happened if you wanted to wait and let it revisit the original breakout line. It literally haven't started an uptrend. So no matter what, if you waited patiently for your second entry could stop you out. Look at the wick, the wick, you mean? Yeah, of course. 1,000,000%, bro. If you think about it, how it started and where it went to and then how it came back. But let me explain something. I'll have to show you on the charts probably, but let me tell you why this wick probably wouldn't have stopped me out. Because if you know me, you know I like to see the gaps. I always say, look at any video. What do I like to say? I like to say the wicks. I hate seeing candles not come back and close the gap. I always say it on my lives. I'm always saying, look, let's let this wick be closed now. Let's let the gaps be closed between the wicks, because otherwise there's a fair value gap. It's imbalance. I don't trust it. I like to see that gap get filled first and then I enter. So I don't know if you have watched a lot of my lives, Viking, but I pretty much all the time wait for these gaps to get closed or some shit like that, right? But you're right though, 1,000,000,000,000,000% correct that if you did just enter, it could have pulled back, stopped you out, and then dropped. And that happens all the time. It happened to me today. But yeah, there's multiple ways to have managed this trade. I mean, anyway. So the key takeaway: avoiding fake outs will make you hesitant and inconsistent. Managing fake outs will make you confident and prepared. Breakout trading isn't about predicting which moves are real. It's about controlling the downside when they're fake and scaling up when they're real. That's why I don't avoid fake outs. I manage them like a pro because they're not my enemy. They're part of my edge. So this is why I try and tell people, right? I genuinely have like made trading fake outs part of my plan. The smash and grab, like read the PDF. I need to do an actual video on the smash and grab, like, because this isn't even a boot camp for the smash and grab. It's more just for like making you understand breakouts and how you can profit from them. But the smash and grab is literally just going for a 20 to 40 pip move and using a 20 pip stop loss, whatever, 30 pips. There's no like strict rules to it. It's just get in and get out. So for me, I honestly rarely ever even wait for all of these confirmations, things I'm showing you. I'm just showing you the proper way to trade breakouts, and then you can go about it the way you want to go about it. But on the stock market open, I'm rarely ever all I'm waiting for is just something to get broken. And you see me, I'm out quick. I manage my stuff, and that's how I've made it a part of my edge, because I'm trying to make you get that mindset shift of not being scared of a fake out, because most of you are scared of fake outs. Like most people, every single time they come to the stock market open, that 9:30 Eastern time is like, I hope this isn't a fake out, or like, I hope this goes in my favor. But you're hoping too much. Like, stop hoping for things, stick to the plan and push the button and control it. All you can do is control it when you're in and when you're out. And if you ain't risking too much, you should be able to do that confidently. Do you know what I'm saying? If I've got a 30 grand account personal, I'm not risking no more than 1,000 on a trade per day. All right, you know what I mean? Or per session, wherever. And that's still a lot. Like, realistically, it is still a lot, but you know, I know that the strategy works, so I'm fine with it. Can you explain ticks for TradingView? Like, how many ticks is a 20 pip on NAS and a 30 pip? Ticks and pips, man. Ticks, pips, points. I know it's confusing. So yeah, to be honest with you, I'm pretty sure I don't even know about ticks, you know, but I'm pretty sure 20 pips and 30 pips would be 200 points, is it? Or 300 points, some shit like that. Or ticks, maybe ticks. I'm actually not even sure. I only use pips, and when I was trading futures, I was still like, it was still just saying 20. So when I was on, it is mad confusing, because when I was on what's it called, Top Step, it still only say 20. Like when I was pulling it down, it's say 20. Like, do you know what I mean? So put it this way: if you pull something down and it says 250, it's probably ticks. That's probably 25 pips. Do you know what I'm saying? It's all the same shit, I think, with just different zeros. I'm pretty sure. I'm not sure though. Don't quote me on that stuff, because you're probably better off asking ChatGPT about ticks and points and pips. Because with me, I genuinely just look and see what I'm like comfortable with, and I'm like, yep, that'll work. And I think that's just come from experience. 30 pip is like 80 ticks or something. Okay. 4 ticks is 1 point. See, yeah, there we go. So what's points then? If I'm thinking about points and pips, I swear, like, it's either 20 pips is 40 points, or 20 pips is like 200 points or some shit like that. I'm not even sure. We'll have to do it though tomorrow. I'll have to get that ready. I'll definitely have to put that in my risk management thing about ticks, pips, and points. Now you've made it a point now. 10 points make 1 pip. There we go. Yeah, so 20 pips is 200 points, yeah? That makes sense. All right, cool. I thought that was correct, but when it comes to ticks, yeah, I'm not sure. But anyway, so before we move on, are you understanding what I'm saying about fake outs? Like, press 1 if you understand that I don't want you to like avoid a fake out when it comes to the breakout strategy. I need you to be in early. I need you to bang, like push that button, because the majority of you probably are so like nervous before the New York Open. You got it in your gut still. You got that feeling, them butterflies. I know it. I don't get those no more, because like I understand that no matter what I do, the only thing I can control is closing the trade. I can't control if I win or lose, unless, well, I mean, like the only way you can control if you win is when you're in green and you press like close. Do you know what I mean? Is it comes with experience, but the main thing you need to get over is the fear of entering in the first place and doubting yourself, because self-doubt is like the biggest trading killer in the world, man. There's so many of you that's probably doubting yourself, and you come to the charts expecting to lose. I don't come to the charts expecting to lose or win. I just genuinely come to the charts and know that I got a job that I need to do. Fear of losing is the problem. Yeah, I get it. I understand. It held me down for years, because that's another thing that we'll get into tomorrow about psychology and risk management. But you need money to burn. You need to be able to literally wipe your ass with the money that you've put in the account and say, that's no longer my money. Like if I manage to take this money somewhere, fair enough. But you can't put money in there if you can't afford to lose it, all right? And that's something we'll get into tomorrow. But you don't need a lot of money to make money, though. So don't get that twisted. Liquidity made simple. Here we go. All right. So this is not going to be no scary, crazy ICT stuff. Someone just dropped a tick size multiplier in the thing. Cool. Yeah, people download that actually. Could be helpful. What is liquidity? Liquidity is just where money sits in the market. All right, so really take this in now. All right, because a lot of people get confused with liquidity. I need you to understand how fucking simple this shit is. Liquidity is where money sits in the market. All the buy and sell orders waiting to be triggered. All right, so think of it like a magnet. Price gets pulled towards liquidity or pushed towards liquidity. All right, it's made up of traders' stop losses and pending orders. So liquidity, all right, this thing that people overcomplicate and make sound so fucking nuts. All it is when price is being pushed down or price is being pushed up, there is liquidity on the push down, the push up. That's why you'll understand now, but it was so intimidating to me until I understood it. Like liquidity now, it means nothing to me. It means, okay, if I was to get in with these people now and push price down, I'm going to put my stop loss there. So why is it that every time I put my stop loss there, it gets hit and then it goes down? Well, that's because our brains were meant to be that way. We're designed to like do it that way kind of thing. When then the big ballers and the people who come in and take all our money and move the way we wanted it to go, that's exactly why it is. We need to start thinking like them, all right? So where do we find liquidity? Above highs, traders who sold put their stop losses there. Below lows, people who've bought, they put their stop losses below the lows, all right? Round psychological numbers, big banks and institutions and the ballers, the big boys I call them, right? They're the ones that are targeting these levels. That's why I always say to you, pretty much every single time there's nothing in sight for me and we're at highs, I'm just looking for the next round psychological number, right? Old support or resistance zones. What do I mean by old support and resistance? I just mean from like the session before. So if we're trading New York session today, then there's probably like people stop losses and liquidity and orders ready to be triggered from yesterday's New York session zones, right? So let's just take a look. Perfect, right? Price was pushed down, starting a bearish trend. So there's a lot of sellers, right? Just look at that and think, okay, clearly there was a shit ton of people selling that day. So what does that mean? Like, think about it. There's going to be a few things that means. One, there's going to be stop losses. So most people with a brain, unlike me, now day traders and stuff, right? Swing traders who trade, think about this is the 5-minute time frame, are going to put their stop losses somewhere up above price, right? They're not just going to put like a few pips, but they're going to be like safe, conservative, whatever. Or they might be stupid, I don't know. Or they might not even use a stop loss. But the point is, majority of the people who got in to push this price down put a stop loss there. And then if they didn't, they want to get back in when price goes back there. They don't want to get in halfway. They don't want to get in there. They don't want to get in there unless they're little scalpers, right? But otherwise, they're going to wait for, the smart money traders and stuff are going to wait for liquidity to be swept. So price does this consolidation, all this shitty range after the move. And then you see this. Now price aggressively, this is the key point I want you to take. Look how price aggressively pushed up. It didn't trickle his way back up. That's not liquidity being swept. That's just, if price trickles his way back up and ends up taking out, the highs from the last session, it's technically taking liquidity, but it's not sweeping it. Now this happened in around about 20 minutes, 30 minutes, right? Now a lot of people who've pushed this price down in the first place, they ain't on the charts like us. They genuinely go about their business. So that's why when a liquidity sweep happens, it happens fast. So watch this. Boof. You see a big wick. That's a telltale sign. All right, cool. We swept the level from up there. We've swept this line out. Took it clean. So what happened just now? Well, everybody's stop losses just got taken out, pretty much, and a lot of sell orders got triggered, right? So people who were waiting to get back in there and they've just set an order for when price gets there, boom, they've just entered, right? And that's the fuel for the price to be pushed back down. So it melts because it's collected liquidity. What's liquidity? Stop losses and people's orders, buy or sell orders, right? But we can use these to our advantage by breakout trading. So that's why I'm teaching you these things. I'm not teaching you how to wait for a liquidity sweep to get in. I'm teaching you how we can actually target liquidity too. Do you know what I mean? Like on session opens, that's when like liquidity sweeps usually happen on like a stock market open or London, you know what I mean? Tokyo, somewhere, the news events, it's just sweeping liquidity. Crane is typing. Press 1 if you're with me so far though. Because like I told you, I'm just trying to teach you about the liquidity shit so you can implement it yourself when you break out trading. Because you don't see me waiting for a liquidity sweep before getting into a trade. It doesn't happen. But I know on the New York Open, when those big moves happen, I know why they're doing it. Like, so it just helps me a little bit. It's like, okay, we're sweeping highs from the Asia and the London session. Do you know what I mean? Like, we're doing some of that. So that's why I come with the CAFX Liquidity Pro. So we don't have to look for it. But it's good to know. It's good to know. You need to know this stuff, right? Cool. So round psychological numbers. Now notice this is the same exact move, right? This is the same exact move. Now I told you I was going to go through everything on the list. So we're going through above highs and below lows right now. But I chose to choose above highs. So when sellers stepped in, their stop losses is all up there above the highs, right? Now notice that this is the same exact move on the next slide I show you, except I'm going to show you round psychological numbers. So take a look at this. That's the exact same move. 23,720. Okay? 740. Now they're round numbers, and I know it was a pip away, but 1 pip away, like, you can't be a dick for a tick, all right? Whoever says that to me, it's true. You can't be a dick for a tick. That's a round psychological number, and it keeps going, right? Like, if I was to have gone down there, it would be 23,540 over there. Like, these round psychological numbers, they get tapped into, and then pop, they drop. And it's usually bang on the round psychological numbers too. It's never going to be like 23,724 or some shit like that you're targeting. You need to just target the round numbers, okay? Oh yeah, and this one's the one where I said about old support resistance zones, right? Whatever. Or support and resistance that has been tested multiple times. You got to think to yourself, why is a support and a resistance being tested multiple times? Like, why has this resistance held up so strong? Because this fucking seller's pushing the shit back down, And every single time a seller stepped in and pushed price back down from this resistance, they were putting more stop losses. People were placing more sell orders because why? Well, if I could half this screen off now, I would, but let's just take it from this first 2 touches. Well, if you're just a support and a resistance trader, you're going to put an order there and think, as soon as price gets back there, I'm just going to put a sell order, jump back in, and my stop loss is there. And look what happened. It would have worked out perfect for them. But then guess what happens? Sellers have stop losses in this area. People have sell orders in this area ready to be triggered. They think, how many times is it going to keep going? It's going to keep going. Boop, it comes up. And it comes up rapid. Snatches everybody's stop losses. Snatches everybody's, triggers a lot of people's orders, sorry. Also triggers a lot of people's orders and stops them out in the same fucking breath. And then it does this. Oh, my bad. Too fast. And then it does this. Bearish engulfing candle. Literally confirming that that was a liquidity sweep. Because you're not going to get a sharp move up like this. All right, leaving a wick and then a big candle like engulfing it, telling us that I'm coming back down. Like, press 1 if this makes sense. Just press 1 if I'm taking my time enough and this is making sense. Yeah, cool. Awesome. This is awesome. Because a lot of people, this is what, where we get faked out. This is exactly where we get faked out as breakout traders. Because in our breakout minds, we're like, well, nah, man, this is a breakout. That's a big ass candle there. I'm getting in. And then boom, bearish engulfing candle. So there's the real breakout right there. This is where we could have potentially got our entry. Because if we go back and go, okay, let's take a look at it. We just looked at what happened. It was a liquidity sweep. Why did it get swept? Because stop losses and sell orders. Bearish engulfing candle. What do we do next? Put our breakout line below, because apparently it doesn't want to carry on going up. And as soon as we put our breakout line below, you know what I'm saying? Like, yeah, maybe you would have been stopped out there. Fuck it. Re-enter. Whatever. It's a liquidity sweep, right? And is overall in a bearish trend. It was in a bearish trend, consolidation, ate some liquidity, and dropped. Like, honestly, this shit can go in our favor so good. So why is liquidity important? Big players, banks, and institutions need liquidity to place their huge trades. Price often spikes to grab it, then makes the real move. Liquidity explains why fakeouts happen and why breakouts run. Literally, a fakeout is usually a liquidity sweep. It's not just a fakeout. Key point, liquidity equals where stops and orders sit. All right, we got that. Price always moves to liquidity because that's where the money is. And I think that's the end of the slide. So now we can get on to the charts. We can do some chart work, right? Quickly. I'm going to get off this screen for a sec. Tell me if that was too intense for you, man. Give me number 1 seriously if that was okay. Or number 2 if you're confused a little, because you can go back and watch this on slow-mo. Do you know what I mean? I'm going to go on the chart, so I'm going to show you in a minute how to spot it and just train your brain. Because once you know it and once you see it, it's going to help you so much. It's going to help you out to confirm like continuations. It's going to help you to like confirm this is a full-on reversal. All of this stuff. It is, man. I'm telling you, I promise you, I wouldn't be just wasting my time teaching you this stuff. All right, so let me get the screen back on. Yo, I really thought I brought some water. Apparently not. This lecture is recorded. My internet is slow today. Yes, yeah, it's recorded. Awesome. Confirms this and give you confidence. Some things that help me detach from losing money. 1, trade within an amount so small you don't care if you lose it. I agree. See losses as business expenses. Connor, that's awesome. Yeah, it's true. Separate myself from my results. Losses don't define my ability. More data to learn from. That's perfect. 4, journal emotions or track process. Did I follow my rules? Build discipline, not frustration, which leads to revenge trading. Daily loss limit. Crane just fucking wrote his trading plan, or her. I don't know. I'm assuming him. But Crane just wrote their trading plan right there. Yeah. Brother, honestly, the shit that I'm seeing there is like perfect. And if you put that alongside an actual step-by-step confirmation list of what you need to get in, if you treat that as your rules, you got your rules and your mindset shit right there. That's perfect. Don't even overcomplicate it. That's beautiful. And then you go on to, am I going to trade continuations? Am I going to only trade you know, this and that, right? But you get the point. Tell me if you lot see my trading view, please. One of you will do. Awesome. Sweet. All right, so right now, this is today's price action. No cherry picking. This is gold. I can already see what I'm talking about. So let's just say I wanted a continuation on gold. Look at this. Now, I know you lot don't see the liquidity sweep. I know you ain't seeing a liquidity sweep right there. Because there's no liquidity sweep technically. Well, maybe a lot of you are. Press 1 if you see the liquidity sweep and 2 if you don't. You do. All right, Jazzalazza don't. 2. Yeah, that's cool. That's all right. I'm going to show you why there's a liquidity sweep. But this is good. I like this mixed stuff. I love this. So I'm going to long it out too much for you, too, which is absolutely fine because, you know, technically on the 5-minute time frame, you know, this would be the liquidity sweep, right? But you got to think, we're on the 5-minute time frame. What did I teach you about multi-time frame analysis? Okay. There's the liquidity sweep. Now you're going to say how? And I'm going to say go to the 1-minute time frame and take a look. There it is. Look at that. Look at that shit. We're in an uptrend. Bop, bop, bop. And then it comes down. Boom. Gives us a fucking rejection on the 1 minute. And then it pushes straight back up and gives us a beautiful breakout. Right there. Liquidity swept. Do you know what I mean? Look at that. Like, honestly. Like, yeah, you can see it on the 1 minute now. But I spotted that shit on the 5-minute. Because my brain's trained that way. Because I know, like, just from trading so long now or whatever, or studying market structure, that this blue candle is actually going to be purple if I go to the 1 minute. Same as this. These are pullbacks. All of these are pullbacks. So, you know, this was a low. This right there, this wick was a low. So I knew on the 1 minute time frame that was a low. Now, if I seen this 5-minute candle do this on the New York Open, which it did, this was the New York Open, mind. Yeah, New York Open, first 5-minute candle. You see that, and then you go, holy shit, that's a liquidity sweep. Oh, wait, there's a big fucking bullish engulfing candle. You know what I mean now? Is it starting to click? Oh, wait. Also, a break of structure. Boom. You know what I mean? Target the tops, or be cheeky, get your sniper entries. Look for higher time frame liquidity, whatever. Higher time frame liquidity, what am I talking about? Higher time frame structure and stuff. And that's how you catch those monsters like this. Do you know what I mean? But I caught that with the eyeball then. And that wasn't even rehearsed. That was just today. But this is what I'm talking about. Continuations. Now a lot of us, we would have went and waited for this. So a lot of us would have waited for this. Real talk. We would have been like this. We're in an uptrend. We need to wait for it to get there. Like, look how shitty that entry is, though, compared to if you knew what a liquidity sweep looked like. And you understood. There it was. And then you got your entry down there. Do you know what I mean? Like, so much of a better entry. It's crazy. It's crazy how things can change when you know little things. So, anyway, let's move on. Let's take a look at the day before. Let's have a look if anything happened there with liquidity and breakouts. Did anything get swept? All right, it did get swept. It did get swept. But the only thing is, well into New York, the stock market open. But all right, you could say if we're going off of bodies. So let's say we're going off of bodies. There's our higher highs. Let's take it back. Let's take it back. All right, let's go with structure. Let's go with structure. And I use candle bodies, remember? So that's a beautiful fucking breakout there. Wouldn't have even needed a liquidity sweep or anything. We would have been in. But let's just say that you did miss your opportunity. You could have thought, all right, I'll wait for a break and a retest. Well, it just came back. It clearly broke straight through there. All right, what else can we do? Oh, shit. You see what happened? Well, it just wicked out the bottom. Let's go to the 1 minute time frame and see if we could have got a better entry. You see that? I didn't get to the top, but or maybe it gets to the top, but still, that would have been enough for me. It does get to the top, I think. There it is. Boom, straight up. So let's take another look at that shit. So let's just say, because I know for a fact anyway, trading the way that we trade, the smash and grab and stuff, we're just looking for a break of this. That's why this strategy is so nice and so simple. We do this, but let's just say you did miss your move. The next thing you do once you've missed your move is wait for a break and a retest. So you put some, the hell? My bad, everyone. So we do this, and we're like, okay, cool. Well, there's our structure. We'll just wait for the break and a retest. Oh, I totally shit all over the support, so let's forget about that. Now, we have one trick left up our sleeve, and that's a liquidity sweep. There we go. Do you know what I mean? Or you could have even done this. No, technically there it would be. It would be there probably, because you move your structure up every time it makes new highs. This would have been your high or low. So then price comes down, does this shit. You know what I mean? There's so many ways that we could have got back in this trade, though, is what I'm trying to say. All we're doing is we're looking for breakouts. You see this? What's that? Number one, if that's a bullish engulfing candle. Number two, if that's a hammer. But no, I can't even trick you. How can I trick you with a fucking bullish engulfing? I was trying my best to figure some bullshit out then. Of course that's a bullish engulfing candle. It's a bullish engulfing candle, and what are these? Please tell me, are these hammers or rejection wicks? Oh, actually, that could have been... No, go on. Number one for rejection wicks. Number two for hammers. Yeah. Yes, they are. They're rejection wicks. There's a lot of names for these things. Do you know what I mean? You know what a doji looks like, right? You know what a doji looks like? Fucking... They don't really matter to us, but these ones matter to us. And why do these matter to us? I'll tell you exactly why these matter to us. Because they're rejecting an area. They're rejecting somewhere. And deep down on a 5 minute time frame, we knew we were bullish. So we want to carry on up. A lot of people are looking at it going, nah, that's a break of structure right now. This is where you got to retune your brain and go, this is not now a break of structure. This is just sweeping liquidity from these lows. Do you know what I'm saying? And then giving us a bullish engulfing candle and a breakout. And there's our entry right there. I'm going to keep it going now. But you always put your stop losses below the wicks, and you always target the tops. And we already seen what happened anyway. And it usually happens pretty quick as well once there's a liquidity sweep, but it's got the fuel that it needed to keep going. But that's how we can implement it in our breakout trading, all right? So that was a 1 minute time frame again. It'd be nice to go and see on a 15-minute time frame in a minute. There we go again. It happens everywhere. What the fuck? This apparently gold's just sweeping liquidity every single session before carrying on. But yeah, right now there's liquidity resting below there. Market opens. Ooh, that was a dangerous one. So that one got swept, but also these lows got swept too. And you got to think as well, why? You got to think why, because, my bad, like I told you, the more pushes and rejections from an area, the stronger that area becomes, right? So when you see shit like this happen, and rejection wicks, it's just usually telling you, yo, like, I'm just taking some fuel. I'm taking some fuel before I move on. Then it's up to you whether you want to, you know, put your breakout line there and enter on the break to the upside and wait. That was a perfect break in a retest, mind, as well. Or if you wanted to just look for a lower time frame. A lower time frame breakout. There's actually no one that I can see. Okay, there it is. There would be your lower time frame break. Oh, probably would have got swept out again, maybe. Let's take a look. Lower time frame break. If you used that structure, you'd probably be alright. But otherwise, if you used this one like me, aggressive as fuck, you would have been stopped out. But guess what would have happened after I've been stopped out because I'm too aggressive? I would have seen this big bullish engulfer and I would have got straight back in. So the point is anyway, liquidity sweeps, they can go in our favor, they can go against us, but it's also targeting the next area of liquidity. And why do I think there's liquidity up there? Because look at that push down. Boom. Sellers are in control. Stop losses. Do you know what I mean? Orders, all of that stuff. Probably going to go up there and sweep it. I don't know. I want to speed up the process though. You going to sweep it? No. Not in that session, it doesn't. Okay. But you need to study this stuff though. And just take a look at how it works. Do you know what I mean? Boop. So you notice what I did? Swept it out. Give you an opportunity to put your breakout lines. And just gives you opportunities. And even though that's a messy ass, horrible ass thing, it's still opportunities there. You know, if you're actually using structure like I told you. And you're trading that way, that's up to you. But I don't trade that way. I'm a smash and grab trader. I smash and grab, I'm in and I'm out. But this is the way I would breakout trade. In my head, just by looking at like liquidity, support and resistance, easy basic concepts, man. Like a lot of people think structure gets broken in an uptrend or a downtrend, but it's not. It's just a sweep. So yeah, number one, if you're with the program. Number two, if you're confused. Awesome, because I don't, like I said, we don't need, we can use this so many ways. Your brains will start ticking soon. Your brains will start ticking and go, I don't want to use liquidity like this. I want to use it like that or this. But as long as you know what it is, like literally as long as you understand that when sellers pushed price down from this area, they put their stop losses there. They put their stop losses right there. Because a lot of people, believe it or not, even though this is a bullish trend, a lot of people genuinely sold there expecting it to melt. Like people do that all the time. That's how their brains are wired. But then, some lows get swept out like this. And then you get a confirmation candle. Do you know what I mean? It's like, holy shit. So people are thinking, I'm selling, I'm getting in, it's broken structure. No, really, it's just come down and swept a little bit of liquidity on lower time frames. And then it carries on up. And where's it target? Exactly where all the people have put their stop losses to, thinking it's going to go down. It just eats their stop losses. Do you know what I mean? It's crazy. It's a constant battle between the bears and the bulls, they say, right? Whatever. Boom. There you go. That's how you know that wasn't a liquidity sweep. That was an actual shift in structure. Because it broke and it retested a structure level right there. And this is where us breakout traders, we whip out our tools and go, hey, let's take a look at this. Oh, nice. Little trend line going. Let's put a little breakout line too. Do you know what I mean? Like this catch our little sniper entries. Oh shit, look at that. Boom. Like easy work for us lot anyway. But tell me, I think all it was for today was to, oh yeah, fake outs as well. Fake outs, fuck. I don't think we covered fake outs enough. So we covered liquidity now. I think a lot of you are understanding liquidity a bit more, probably. Hopefully anyway. Because I don't want to make it confusing. I want to make it easy for you. They're just extra confluences. Fake outs. Probably going to have to go to NAS 100 for the fake outs. This is so fucking many of them. Sorry about my language as well. It's terrible. Right. All right, here we go. Fake out, gang. But is it a fake out? It's liquidity, right? So, NASDAQ, 5 minutes before the open, the stock market open, What do we do? Well, in situations like this, for a fact, I probably would have said, yeah, that's far enough down. Yeah, we can deal with that. But then I'd say, we need to go to the 1 minute to look for some structure. Yeah, cool. So, because we're right there, that I'd be doing this, right? If you rode with me for a while, then you'll know that that's what I would do. And then I would do this. Oh my days, there it is. There you are, you cheeky little bugger. So you see that? Boom. Now I would have entered that. Like at one point, this candle was giving us vibes, right? So I would have entered that, and 100 I would have lost. All right. So let's just say I entered there. 25 pip stop, sometimes a 20 pip stop. You know, I'm aggressive. I would have just lost the trade anyway. That's the point I'm trying to make. Or I would have closed it. Whatever. It's a bad trade. That's why I always enter on a second trade. 25 pip stop or a 20 pip stop. Then I target the bottoms. Oh my days, there we go. I ain't avoiding it. I lost. I just got fucked up twice. Horrible day, absolutely horrible. So even the smash and grab wouldn't have worked there. So look at this. That's 2 fake outs right there. It murked me. It destroyed me. Does that happen all the time? Yeah, it does. It actually does happen all the time. But let's see if you was only waiting for liquidity to be swept out. Let's just put this shit to the test for a minute. That's the opening candle there. So it does sweep the highs, all right? It does. Even this, just that there, that's the liquidity sweep. Doesn't look a lot, but it is. You've already triggered a shit ton of orders. And then it does some business. Now, if you was to have got in, you know, somewhere after, even this candle there, but you have to use the wicks or the structure. If you're trading this way, you have to do that. That's just a must. My next breakout level would have been all the way down there on the 5-minute time frame. It just would have been, all right. And then I could have got my 25 pip stop if I was only using the 5-minute time frame though. So let's run it back. I'm only using the 5-minute time frame. I'm using 5-minute structure. I've just seen a liquidity sweep. Cool. There's a pullback. Oh, actually, there we go. There would have been entry. As soon as it breaks through, whatever, 25 pip stop. You target in the bottoms, right? You're seeing how this shit is like making sense now. If you was to only use like liquidity sweeps and then get your breakouts, like that's one way. That's one way, but I don't do that shit. I never really do. Let's take a look at the next day. When was this? Thursday the 4th of September. So that's the opening candle, obviously 5-minute time frame. Nothing wrong with that. That's even a valid trend line. So if you remember now and you go back and watch the trend line video I showed you, I would have said that's valid because, yeah, it broke out. This is another interesting one. What did I tell you before? And I said, if a trend line gets broken, it doesn't mean that the structure gets broken. Well, in this case, structure did get broken, but look what happened. Liquidity sweep. Now do you see it? So instead you thinking, oh, the structure got broken. Nah, that just swept liquidity from them highs and dropped. So anyway, New York Open comes. There we go. So what is this? This big blue candle, all right? It's a liquidity sweep. It's sweeping all of the stop losses from down there, even though this one did too. This is the big boy one. Boop, big sweep, and then it does that. Why do we not avoid fake outs? Because if we wanted to wait for a confirmation, technically, from everything I was taught in trading, this is called a big ass fucking bullish engulfing candle. People say you get in, you put your stop loss below the candle and this and that. We can't do that, all right? We just can't. That's a 70 pip candle. So for me to avoid these fake outs is when I miss these moves. It's just the psychology, all right? So I get in as soon as that shit breaks. Boom. 20 pip stop loss. And I'm targeting the tops. I might leave a runner, whatever. And then it always does this shit. Always comes back and does some nastiness. All right? Look at it. Like, look how nasty NASDAQ can be. But also, take a look at the art of it. If you think about it, it swept liquidity both ways and then went on its merry way. So look at that. All it done was take from these highs, all the liquidity resting there, and it took from these fucking lows. Swept both sides and then carried on doing the business. started a little uptrend. Do you know what I mean? It's even there, it took liquidity again, right there, from there. It's all liquidity, every single part of it. Do you know what I mean? So number one, if you're still with me, or have I lost you somewhere long down that road? Yeah, you kind of get in and out, cool, yeah. We ain't avoiding no fake outs. No avoiding fake outs. So when was this? Wednesday the 3rd of September. You all get the picture by now. So I want to ask you a question, people. I'm going to ask you a question. So, okay. 5 minutes before. Ugly chart. That is an ugly chart, I'm not going to lie. Yeah, that's ugly. 5 minutes before. Fuck's sake. Don't think there's a good example, actually. But I was going to ask you, number one, if you put your breakout line there, or number two, if you would put your breakout line there, or number three, if you put your breakout line there. So 1, 2, or 3. Which one would you choose? 2, 2, 3, 2, 1 or 3. I like it. I like it. Because you know what I would have done? I would have chose, personally, myself. If it was possible, I would have chose 1, because of course we want our sniper entries. But what do I always say? That's way too close for the next candle to open. So instead of me going all the way down there and missing the whole thing, I'd probably use this wick. So it'd be number 2 for me. Oh, and do you know what's bad about that? Look at that shit, man. I hate these bar replay modes. Alright, so that could have definitely stopped me out. Right, let's take a look at it. The candle starts there, finishes there, gets that far, but gets this high. Yeah, that's one of them bullshit ones. Yeah, we these fake outs, as I'm saying, though, if you're looking for a place to be faked out, is NASDAQ and US 30 on the stock market open. If you're looking to make a load of money, is also not NASDAQ and US 30 on the stock market open. But we just can't avoid these fake outs. We have to take these nasty days as they come. We just do. They suck. But yeah, I believe I would have lost that trade just because I think it would have retraced. Yeah, it would have started there, came down, it would have done this, whatever. I think, or maybe it could have started there, got this high, finished there. I don't fucking know. It looks like a nasty trade, and it looks like I would have lost. Second entry could have been another fake out. So the amount of double fake outs that happen with this strategy is nuts. Let's move on. Because when we got our clean days, we got our clean days. Look at this. Liquidity sweep. Swept. Clear. I don't even need to put the indicator on, but I'm doing it. Alright, I'm not going to be long with this lesson anyway. We're almost finished. But look at that. Take the 1 hour liquidity off because it's just too scatty. Boom. So we know this 4 hour liquidity there without like scrolling all the way to the left and looking for you know, where the structure is. When you see this shit happen, be real. I think we could have made money that day. Like, let's take a look. Let's pull it back, actually. Is that the 5 minute candle? No. All right, cool. So probably put out our thing there. If we were smashing and grabbing, we still could have made money that day. 1,000,000% if we got in there. Tight ass stop loss. See, 25 pip, 30 pip stop. We definitely could have made some money. But the chances are a lot of us would have held. We would have got stopped out, right? Or, you know, we wouldn't have took that. We'd be like, nah, that's too much. I mean, that's not enough, sorry. So our second entry. This is where, like, knowing that this was a liquidity sweep, knowing how that candle closed, leaving a big wick like this just isn't enough. But look at this part of the candle too. Just look at how it closed. It fully told us a story. It said, I've just swept the 4 hour liquidity zone. Check. I've closed back up inside where, like, the area that you wanted me to. sorry, the area that you wanted me to break out of. I'm not ready to leave. And look how it closed. Like that body there closed well back up above. So the body didn't close towards the bottom and leave a wick towards the top, because it would have told us it wants to go down. That's clearly telling me it wants to go up. So that's two confluences telling me, you know, if it breaks this now to the upside, I'm quite comfortable getting in. And then we see this, and we're out. We're already done. Like, you can hold if you want, but I'm done, because I probably understand that this is just another sweep of liquidity before dropping. Oh, what did it do? Swept out the level, left this nasty ass wick and said, I'm done. I've just swept another liquidity level. Now you can either get back in or leave. Be done for the day. Do you see? Is that making sense to you? Press 1 if this shit makes sense to you. Awesome. I feel like I overcomplicate things sometimes, but yeah, I just wanted you to know, man, like, we don't wait for a level to be swept and then enter. I mean, you can if you want, but because we ain't trying to avoid fake outs, we're just trying to get in there really brave and aggressively like a Spartan. As soon as we get in there, we need to understand, right, we're either closing before we lose money or too much money, or we're closing, you know, because we've just seen this shit. Like, we got in for the downside and we thought, yo, we're all in, guys. Everyone, we're in for some money. We're going down. Like, this shit's gonna melt. And then all of a sudden it does this, and we're like, oh. But then with a brain, we can say, but wait a second though. That was a liquidity sweep. Cool. Now it's swept liquidity to the downside. Surely is happy enough to go up a bit. There we go. Sweet. Do you know what I mean? That's why we use liquidity. Just like this as well. I am gonna end the fucking lesson now, but just like this as well. There we go. So this was New York Open. So we know every single time price gets pushed up, buyers, stop losses all below there. We're cool with that. So we know there's liquidity rest in there. We know that shit now. But we don't really care because we're putting breakout lines there. We usually get in anyway. All right. That's what we do. Market opens. Boom. Now, we ain't waiting for this to show us it was fucking liquidity sweep. We're not doing that. We're getting in on the break. So as soon as it broke, we was in. We was already in. Damn, man. See how sometimes stop losses look like nothing? Like, why is it that day 25 pips looks like that? Make that make sense to me. But anyway, all right, regardless, that's some shit right there. It happens. It tricks me out sometimes. It makes me bug out. But whatever. What I'm saying is, at one point, this candle was this big. We were making money on that. Like, all of us would have been in. I would have been like, I'm done. 5-minute candle was crazy. It just melted. I'm done. Or we wouldn't have. It would have came back and it would have showed us once again liquidity sweep. Do you know what I mean? You see it? Break, retest, continuation, bullish. Starts a little bullish trend after they swept out the liquidity. But that's all it is to it, man. That's just what I wanted to teach you a lot today about fake outs, not avoiding fake outs, and seeing the liquidity when is like time to see it. So if you get in and you get faked out or whatever and you lose, you're like, damn. But then you see, oh wait, we're in an uptrend. You know, like, we're in an uptrend. But Connor always tells us to put our breakout lines there and put our breakout lines there. And it's whatever one gets broken first, we get into, right? And then we see this and we go, yo, I'm getting in. And we get in and it comes down a bit, cool. But then all of a sudden, it fucking closes back like there, leaving a big ass wick like this. Well, now we know, oh, all right, it left a big wick, cool. Liquidity sweep. Now I'm confident, sorry, getting in when it breaks to the upside. Boom. Makes sense, yeah? Good shit. I think that we can be done for the day, honestly. I think that we can be done for the day because we don't need to overcomplicate with breakout traders. All I wanted you to know was why that stuff happens, where it is, what it is, and you can watch this video back and you can take it in. I don't know how to use that tool. Can you please go over it? Do you have a video on it? I'll briefly go over it because my mouth is like fucking sandpaper and I need to go get a drink. Right, let's do this. So, all right. You see these lines? Let's take it from the beginning. Reset settings. Right, this is what it's going to look like. This is how it's going to come straight out the pack. So I go like this. Take these first two off. This is all recorded, mine, so you can go back and watch it. Now, because we're day traders, scalpers, all right, highest time frame we're going to want is 4 hours. So set that to 4. Set this one to 1. Doesn't really matter what way around. I like my colors purple, but you can do whatever you want. It really doesn't matter. This is just personal preference. All they are liquidity levels, right? Lines showing you where liquidity is. So change this to dashed if it isn't, and change this to 1 hour. So that's the settings you want for when you're scalping, okay? On the 5 minute and the 15 minutes. If you go to the 1 minute time frame, then sometimes you might want to change things to, like, you might want to change the 1 hour to the 15 minute, because then it gives you 15-minute liquidity. And also make these darker too. Now you can actually see them. But the point is, all this tool is an indicator to show you where liquidity is, instead of you having to just go through everything I've just shown you and being like, oh damn. But I also now I changed the 4 hour one to like 10 for thickness. So now the thick lines are the main ones. They're the ones that hold the most power, especially when you're trading on a 5 minute time frame, right? So let's say we're on a 5 minute chart. There we go. There's my TPs. Does that make sense to you? So all you need to do is target those lines. Every single time a line gets tapped out, it gets dashed in grey. So let's take it back to a point in time where we were right there. All right. We put our breakout line there. My bad, everyone. We put our breakout line there. And we put a breakout line down there. Now we know if we break to the upside, potentially there's our TP, you know. Because if some people are scared to hold, they don't know how to hold, they don't know where prices go in. But did you just see what happened? Literally, if you were just held and said, I'm holding for that, that's 1 hour liquidity right there. It gets swept. Now you can expect a reversal because liquidity just got swept. And that's how it works. Once it's taken the fuel that it needs and is fed, it'll go where it wants to go. Does that make sense to you, Alpha Trader? Also, you can go back and watch this as well. But let's just say, you know, this is the open. We want breakouts. If we break to the upside, there's our TPs. There's our TPs. The thickest ones are the ones that hold the most power, but the 1 hour ones are also fine. But you see what it did? You see how it targets that 4 hour liquidity and just eats it alive? Don't know why it's lagging for. There we go. But there we go. Obviously, though, don't just think, right, I'm going to like get in and target every single line, because all these lines are going to go down for miles. All right, because it's just all previous structure. You're just going to want to like target the first few, like the ones that kind of line up with the structure anyway, and then you can be happy. But yeah, that's what happens. Oh shit, it did kind of go down miles. Yeah, that day was a monster. But once it's had enough liquidity, fuel, it will make a reversal. Do you know what I mean? And it will go and take out the upside liquidity, like you just seen it do. So go and have a play with it, man. But I'm going to sign off because my mouth's dry as fuck. I need a drink. I'm hungry. I think it's been a good session. And yeah, I just think that I'm ready to end this session. I don't think we need to do any more. Like, I just wanted you to understand not to be afraid of fake outs and why we target liquidity and what liquidity even is.